Good afternoon and welcome to BizTech's ASEAN Midday Market Watch. Our guest today is Jeff Halley, Senior Market Analyst, Asia Pacific at OANDA. Jeff, good to have you back after your holidays.
Yeah, thanks very much. I'm actually working remotely for the next couple of days, but I'm not telling viewers where I am because I don't want them to get upset or jealous.
Yes, I think let's not, at least you can move out a little bit out of your environment. Most of us are, as it is around the world, the next wave of lockdowns are coming in. So we're all trying to stay away from people as much as possible.
Yeah, much the same here. With the start of Ramadan, there's very little domestic travel. So it's an opportunity to move around in Indonesia, but not meet too many people.
Now, let's take a look at how markets in the region are performing. It's very much negative numbers across the region. We start with the SGX, which is at 3,151.92. It's down 1.26%. Bursa Malaysia is at 1,601.3. It's down 0.39%. Across the region, Japan is hit hard again. It's only at 28,502.25. It's down again 2.06%. Shanghai Composite bucks the trend. It's at 3,478.06. It's up 0.15%. The Hang Seng is at 28,661.58. It's down 1.36%. The ASX 200 is at 6,955. It's down 0.87%. And rounding up the numbers is the Kospi, which is at 3,168.48. It's down 1.63%. Jeff, what's the reason for these rather bad numbers across the region?
There's a couple of factors at play here, Brian. In the Nikkei in particular, they've announced that Tokyo will enter a COVID-19 state of emergency from the 29th of April. I don't know why Tokyo needs 1 week's notice for a state of emergency, but such as it is in Japan, and that is definitely weighing on sentiment in the Nikkei today. Overnight, we saw US markets finally retreating as bullish momentum ran out of steam. It was sort of a buy the rumor, sell the fact situation with US earnings. And because there's no other real drivers around at the moment, investors asked themselves what next, and then decided to head to the sidelines. That sentiment, that risk aversion sentiment, or I really call it profit-taking sentiment, has been moving across Asian markets today. In markets where we see a lot of hot retail money, South Korea, Japan, Australia, and to a lesser extent, Singapore, where I guess this COVID-19 is causing concerns that the ASEAN recovery may be delayed. We've seen those markets underperform, Hong Kong as well. Interestingly, Chinese markets, CSI 300, Shanghai Composite, they're flat for the day, and I suspect that the Chinese national team of state-affiliated fund managers are in there smoothing markets at the moment.
Now, let's look at Australia. Retail sales numbers came out this morning. They were up 1.4% in March from February. Now, that was higher than expectations of 1%. Also, the Australian consumer is spending. We've also had positive export numbers out of China, out of Japan, out of Singapore. But on the other side of the equation, as you just mentioned, the COVID situation in Japan, also terribly in India, is worsening dramatically. So do you think that one of the things that's happening is that whole global growth narrative is going to start losing steam as more countries then start to experience lockdowns?
Yeah, and we can see cases increasing in the US, and also we've got massive problems in Canada as well. COVID-19 hasn't gone away, and those vaccine rollouts everyone's talking about are very much limited to the United States, Israel, the UAE, and to the UK, to a lesser extent, European Union. The rest of the world is all in a long queue, and we look at Australia, their whole vaccination program has been thrown into chaos because of the AstraZeneca situation and the India export ban. So I don't think it was ever going to be a smooth road. And I think in the absence of any other strong news drivers, investors are starting to look at this and perhaps take a more realistic attitude towards the pace of the global recovery. We take a step back and look at it from a longer term perspective. these vaccines only arrived in November and December and January. It's only a few months ago. So it was unrealistic to expect that the world would suddenly be out of the woods within 6 months.
Yeah.
But I do believe that it will accelerate in the second half of the year as that production ramps up.
Now, obviously, I think part of the reason is a lot of that optimism was priced in markets, and now
Correct.
basically people are taking profits off the table and taking a more realistic view of the rollouts.
Yeah, I agree. I think there's a huge amount of good news priced into global markets. At the end of the day, central banks are still keeping rates at 0% and flooding the market with liquidity, the financial system with liquidity. So I don't for one moment believe that this asset price inflation story that has been driven, well, since the global financial crisis really by central bank quantitative easing is over by any means. But I don't necessarily believe it'll be a straight line like it was in 2020. And I think that's something that investors are going to have to get used to. But I think buying structural dips in some of these stock markets is still probably going to play out, to be honest, because I believe property prices, equity prices, etc., are all going to be higher by the end of the year for the reasons that we've just outlined.
Now, what is your view then on commodity markets, particularly the price of oil and gold? Because after all, with worsening, with lockdowns, you have less demand for oil, and oil is trading pretty much in the 60s over the last couple of months.
Yeah, India is the third largest importer of crude oil, crude in the world, and they matter. So if the situation gets even further out of control there, and I am concerned about what I'm seeing over there, then that could put a temporary blip in the oil demand equation. But the US is firing ahead. European data is strong, UK data is strong, China data. There's clear evidence that this recovery in key rich developed markets is taking hold and is accelerating. So although oil may face some short-term headwinds from examples such as India, I don't think it undermines the bullish narrative. There are some concerns that Iranian sanctions may be eased because the talks seem to be going quite well. So if millions of barrels of official Iranian oil hit the markets, that would also be another headwind. But I believe that again, oil is probably in a buy the dip scenario rather than we're seeing a structural high. Having said that, I think $60 to $70 in Brent crude is a very reasonable range to expect for the rest of the year, because OPEC will increase production as the economy globally recovers.
Now, Jeff, thank you very much for your insights.
Always a pleasure, Brian. Thanks for having me, mate.
Now, we've been speaking to Jeffrey Halley, Senior Market Analyst, Asia Pacific at OANDA on BizTech's ASEAN Midday Market Watch. I'm Brian Fernandez. Check out www.biztech.asia for business and technology conversations. This video will also be on our LinkedIn and Facebook pages, so please subscribe, and thank you for watching.